is Melvin. Welcome to Financial FixIt. I'm a property investor myself and also an entrepreneur. I've now run an 80 units of Airbnb business ranging from studio to bungalow. Now, in the past 4 years, I've also invested in a lot of properties, and now I'm in a mission to go out there and help my students to buy property for free. Why do I insist in doing that? Is because I find that in the current market right now, there's a lot of people that buy property, but the property doesn't generate them income, it doesn't make them money. Because of that, I believe in having the great fundamentals are more important than buying the property itself. Because what's the point in buying a property that doesn't make you money, right? Okay, so as you remember from the first 2 episodes, I've covered about credit scores, I talked about income stability, and today I'm going to talk about debt service ratio. And what does this mean? This means if you're going to take a loan from a bank, right? How can a bank know that you have the capability to pay them back, right? Of course, you have an income, but you still need to prove to the bank that I have the capability to pay you back. And that's how you can get loan approved. Okay, so let me show you a little bit about this. So now, assuming now if you're as a person, right, you want to buy a house, first thing you need to prepare is what? Your down payments. You pay 10% is your standard down payments, right? But if you want more tips, okay, maybe I can teach you a little bit about how you can get it even lower than that. But let's stick to basic first lah, huh? So now, 10% you're going to pay for your down payment, and then 90% you need to finance from a bank. You're going to take a loan from a bank for the balance of 90%. But if you ask a bank right now, assuming now if you're a bank right now and you are willing to give out a loan, how much risk are you willing to take? Definitely zero, right? Correct? You don't want to lose your money. So same goes to a bank as well. So as a bank wants
a zero risk.
They're not willing to risk their money, right? And therefore, they'll do a lot of due diligence on you. And today, I'm going to talk about how the bank access you through debt service ratio. So with debt service ratio, right, basically the bank wants to know what is your capability. Are you capable to pay them back or not? So in this calculation, right, they'll need to know what is your income, right, versus your expenses. Because after your income, you need to pay all your expenses before you have additional money to pay the bank back. So that's why they'll access you in this way. So now, let me give you the formula that all banks use in order for them to go access every person to go out there and take their loan. Right, so first thing first, over here, you can see this formula, right, is your total commitment. So what kind of thing can be your commitment? It could be your PTPTN loan, your student loan, right, your housing purchases, right, your hire purchases, which is your car loan, credit card, personal loan, and that's all your commitment that is through a bank. Does your insurance, your telephone bills into it? No, actually the bank doesn't, because what they see is what indicates in your credit score only, and that's I already covered in a previous video, so you can go check out later. So now, that's all the commitment you need to put in down here. Then after that, once you have your total commitment, what you want to do is you want to put your income down, right? Your total income. So let me put this example, right, over here. So assuming now this person over here has a 5K income. So that means here, total income I'll put here is 5K. Okay? Now, next, what I'm going to do is, let me give an example. Assuming now this person has a car loan, maybe a monthly installment of 800, okay? Plus, let's say this person has also a personal loan at 800, okay? And also, this person now, next, this person is trying to buy a house, right? If you are also trying to buy a house, maybe you can look at this as well. So this person is trying to buy a house, right, by taking a loan that worth 1,000 a month of installment, okay? It's a new house worth 1,000 a month. So, this is a new commitment, this is an old commitment. So in this calculation, what you want to do is, you want to add up all this, right? That comes to how much? It is 2,600. 2,600 is the total commitment, all right? Use 2,600 and then you divide by your 5,000 income, okay? Don't forget, this is your income. Okay, this is your income. Once you divide this, you should get what? A percentage, right? Once you times this 100%, you get a percentage, right? In this case, this would be 0.52, okay? So now, your commitment, right, should be what? Should be 0.7 or below. 0.7 or below. So in this case, you get 0.52. So it is more than this or less than this? It's less than this, right? So once you have less than this, that means you have the capability of paying the loan back. But if you are more than 0.7, that means you have already burst your DSR. So when a banker tell you your DSR is burst, that's why your loan is rejected. This is the reason. So as long as you want to get your loan through for the next time, make sure you maintain this part less than 0.7 And I assure that with a combination of the rest of credit scores and your income stability, you are able to get your loan through. So now I've already covered how a bank actually access a person before they get their loans through. It's mainly in these three parts called your credit score, income stability, and also your DSR. So as long as you are able to master these three parts, I'm assured that your loan will go through. Right, so I've covered all the basic needs for a bank to access you. So if you are able to master that, you'll definitely get your loan through. So now, if you think that your case are more complicated than this, you can also comment below or you can personal message me so that I can help you through to get your loan, okay? If you think that you have more difficulties in getting your loan through, okay, follow me for more tips, okay? So until then, see you.